Good morning, everyone. Welcome to Main Management's weekly market note for the week ending May 9th. It's currently Monday morning, so we've had some news over the weekend, which we'll touch on. But with me, I have,
Alex, research analyst on the team here at Maine.
yeah, and we'll go ahead and get started here. Starting out with just the weekly performance and year-to-date performance. Year-to-date, you're going to continue to see those defensives have led, even with the increase in some of the more cyclical sectors this past week. You can see industrials led the way last week, and on the left side, you had commodities, which, overall, not a super active week. You had healthcare decline considerably, down 4.2 off the back of some tariff increases or rumors or some targeting by the Trump administration on some of those healthcare costs. Any other thoughts on performance the past week?
No, nothing specifically. It was a relatively uneventful week.
Moving to recession dashboard, again, pretty much the same as last week. No major changes. Continuing to watch the employment, which is our only red level on here. But other than that, fairly benign, as we've already discussed. On to Q1 productivity. We got this on Thursday, and it was a negative reading, which was expected given the kind of noisy volatility in some of this first quarter's readings, including GDP. I think our broad takeaway is that we continue to see that trend of productivity be positive, and it's not unusual to see these kind of quarter to quarter changes be negative sometimes, especially when things like massive imports and front running of tariffs happen. Like that just kind of distorts all of the data that runs or that depends on those. Um, but overall, I think we're not too worried about that. Um, Moving to kind of the longer term trend and some details in the report. That left hand chart is the 20 quarter average, and it's been an uptrend basically since COVID. You've seen this, or even before COVID, like 2018. You've seen this trend continuing to increase on a broader scale, and we think that trend, as I mentioned, will continue. A lot of that is from the adoption of AI helping increase workers' productivity. Um, I think there's going to be some noise as the past 20 quarters, the two quarters rolling off over Q2 and then Q3 of this year, those overlap with Q2 and Q3 of 2020. In other words, those quarters will kind of dissipate from the data, or from this 20 quarter average that in the 2020 numbers, meaning you might see some drops as those 2020, those Q2 and Q3 of 2020 numbers were very, very strong coming out of the pandemic. A lot of that was distortion of moving to remote work away from these retail jobs. Anyway, my point is this data is noisy. The longer term trend is still positive. Alex, do you have anything to add?
Yeah, I mean, so both of the previous sort of large long-term productivity booms went up. For starters, they went up to 4%. So we're really just getting started, and as James mentioned, wider adoption of AI is something that's only going to augment this. Um, and the other big thing to mention is that both those prior productivity booms were also tech driven. So the first one you had the mainframe computer, the second one you had the longer rise of the internet. And so this is something that we've seen before.
Mm-hmm.
Um, and a trend that we expect to continue. As James mentioned, there's a lot of distortions in the data, especially with this past quarter. If we hadn't seen sort of that import front running, it might have looked a bit different. So you still see the broader trend, despite maybe some rocky data for this month and the next couple months.
Moving on to the trade balance, this talks a lot about the kind of import surge that we saw prior to tariffs or front running these tariffs. I think confirms what we've seen already in the data and in the Q1 GDP. So not a ton to hit on there, just kind of the absolute magnitude of how much actually came in. Any other thoughts on this?
Yeah, no, I mean it was expected, given sort of the tariff outlook. I'd say one specific interesting subcomponent there is in pharmaceuticals. You can see here that they jumped 21 billion. Our pharmaceutical industry is very heavily intertwined with China, and that sort of accentuates, I guess, those concerns. So that was an interesting subcomponent, unsurprising. It'll be interesting to see what happens to that now that after this weekend tariff concerns have
Yep.
come in a little bit, to see if that trend continues or if we see a pullback there.
Yeah, I think, touching on that pharmaceuticals, I think that's still the case here. You can see kind of the overall good imports from different countries. I think we should talk about China here a bit. Obviously, the headlines over the weekend was, were that they were negotiating. They came to a deal, and then this morning, or kind of last night, they came out and had announced that the U.S. was dropping their effective tariff rate from 145 to 30% on China. It's kind of that 10% baseline. Plus, they have this 20%. That's kind of this fentanyl associated tariff. And then China is also dropping their rate on the U.S. from 125% to 10%. So kind of drastic decreases in both of those rates, showing they're finally getting to the negotiating table and actually getting to a point where they're able to agree. And I think there was some interesting commentary I saw was that it was a joint collaboration where they're both working on it together. Even in the announcement, Secretary Scott Bessent was very respectful in the way that he was talking,
Yeah.
which I remember China had said, if we want to negotiate with the U.S., they have to be respectful to us. So I thought that was very interesting that they've gotten to this point now where they started out with the firepower, started out with kind of the inflammatory, retaliatory tariff rates, and now they're at the point where maybe they're getting, they're still going to be tariffs, but they're down at a more tolerable rate to companies.
Yeah, no, I mean, I think the biggest thing this shows is a sort of willingness to come to the negotiating table. Like you said, I don't think it eliminates the possibility of resumption of future tariffs. Certainly not of the magnitude that they just were.
Yeah.
But it is a sort of market change in, I guess, attitude towards the Chinese when it comes to negotiating. There's a step in the right direction for sure.
Yeah.
At least markets think so.
Yeah, absolutely. The big thing last week that we haven't mentioned yet was the FOMC meeting. So it was fairly kind of tame. No one was expecting any sort of movement on the rate front. Most of it was focused on the commentary. And Powell kind of reiterated what he's been saying for a number of months, which is that they're being data dependent, that they're watching to make sure that inflation doesn't run away. That's their main concern. They seemed pretty, I guess call it not worried about the labor market. I think we're probably a little more worried than they are. Obviously, they're watching it just like we are. They're watching the same data, but I think their worries lie more in the potential stickiness caused by tariffs on inflation rather than the weakness in the economy caused by tariffs. Any thoughts on this?
Yeah, I think the pricing in of 3 cuts is fairly interesting. It's been that way for a while, or sort of hovered around that range.
Yeah.
Even though, as you mentioned, the last FOMC meeting, Powell's commentary was, if anything, slightly hawkish in the sense of inflation being their primary concern. I think this recent news with China will help a lot in sort of easing the Fed's concerns about inflation, and maybe shift the focus a little bit more to unemployment.
Yep.
There are some somewhat concerning trends there around the edges.
Yep.
Especially with regards to new university grads, and so that'll be something to continue watching.
Yeah, I think it's the Fed's kind of remaining on standby. It's one of those things if you're looking at the kind of expected number of cuts, it feels like they're getting pushed further and further out. First it was they're going to cut by May. That didn't happen. Then it was June. That doesn't seem to be happening. Maybe it's July, and that's also getting kind of priced out. So I guess overall, it's kind of one of those things. If the economy does weaken, if tariffs actually do really hurt the labor market, they'll probably cut a considerable amount. If that doesn't end up materializing, maybe it'll be only 1 to 2. And then if you wait weighted average those probabilities, you end up somewhere around 3.
Yeah.
But we'll kind of have to watch and see what happens. On inflation expectations, I mentioned these earlier, but this is what Powell is very, very much watching, and the rest of the Fed is watching to see if these tariffs will actually result in some stickiness, because basically there's this theory of inflation, or part of the theory of inflation is that part of it is caused by what people expect will happen to inflation. It's kind of this self-fulfilling prophecy where if people think prices are going to rise, businesses will will increase them, and they'll end up rising just because people think they will. So you've seen off of the news of all these tariffs, the 1 year especially has been absolutely skyrocketing. The 1 year expected inflation rate, the longer term expected inflation rates, like the 5 years, 3 or 5 years, have been kind of steady. This rate, or this survey in particular, the New York Fed survey of consumer expectations, you saw the 5 year actually ticked down to 2.74, but the 1 year is still increasing, 3.63. Overall, I know this survey in particular has not reflected the same kind of magnitude of inflation expectation increases as other surveys, but it's still showing that the short term is kind of rising and the long term is staying more steady.
Yeah, I mean, I think these inflation expectations broadly have been pretty elevated relative to what the actual data shows. And, like you mentioned, that could turn into a self-fulfilling prophecy.
Yep.
I do think this recent news is going to help a lot with that.
Yep.
People have been, for lack of better words, overreacting to the actual implications of the tariffs from an inflation standpoint. And it's been very news dependent and what's going on with Trump's policy.
Yep.
And so a bit of a reversal this weekend should bode well for inflation expectation readings.
Yep.
At least I would think.
Yeah, I mean, we've touched on this, how politicized these things, like not only just surveys, but even things like inflation expectations have become, given the politicized nature of inflation over the past 5 years, kind of this post-COVID, it was Biden's inflation, and then Trump came into office and wanted to put on tariffs and became Trump's inflation. So people are seeing the headlines of putting on these tariffs, taking off these tariffs. I'm sure it'll move these around with a lot of volatility relative to the past.
Yep, definitely. So, moving on to the next slide, something interesting here is, the financial situation compared to a year ago with regards to unemployment. What you see is that those expectations are starting to slowly worsen around the edges. And this is part of that concern that I brought up a few slides back. I think part of it has to do with AI and the concern over AI taking jobs in the workplace. Certainly, it's making jobs harder to get. It's allowing companies to become more productive with their current employees. It as we've seen, highly augments worker productivity. And so that's something at the margin to sort of look out for. I don't think it's overly concerning yet, but it is something we're watching and something to sort of keep monitoring.
Yeah, there's a lot of discussion on tariff uncertainty, businesses not willing to kind of make the heavy lift of capital expenditures or investment when it's unclear what the tariff rate will be over the next, call it, 4 years. I think there's kind of this underappreciated level of uncertainty associated with AI, where a business, and I mean, we've experienced this, where it's unclear with such a rapidly advancing technology what it'll look like in a year or 2 or 3, to where do we want to make the, I guess, expenditure, the labor expenditure of onboarding and bringing on new people, especially when we're not sure what those jobs will even look like in a sort of super efficient AI kind of augmented workforce. So I think there's a lot to be said on like uncertainty just over the next few years.
Definitely.
And that obviously hurts expectations, that hurts kind of sentiment. Overall, like, uncertainty is something that people do not like to have, even if it's this positive uncertainty of this advancing technology.
Yeah, and I mean, it's not necessarily unprecedented when it comes to new technological innovation.
Yep.
Over the long run, that usually creates jobs,
Yep.
and concerns about sort of jobs being taken are overblown. But you have seen in the past that there's a short-term negative impact on
Yep.
employment.
Yep.
That's and that's sort of as the economy sort of, I guess, figures out, recalibrates
Yeah.
exactly what the new jobs look like. So it's, these concerns aren't necessarily unwarranted.
Yep.
I don't think over the long run there's something to be as worried about.
Yep.
But there could be a short-term impact there.
Yeah. So that's all for this week. You have a summary slide here. I think a lot of it, we touched on basically FOMC last week, fairly kind of on the sidelines.
Yep.
And then the China tariff news coming out over the weekend was the big thing to watch. I think these trade deals continue to come out with countries. You have the UK, now China, and we'll see the rest of them. I'm certain that we'll continue to see more, and I guess we'll have to wait and see to actually see what those rates end up being. I think the China one in particular, going from 145 down to 30, is a good sign for the rest of the countries, where they'll probably go from wherever they're at to a implied lower number if they're willing to go that low with China. But yeah, we'll have to wait and see.
Yeah, and looking at the upcoming data, all eyes are sort of on inflation this week.
Yeah.
As we mentioned, that's what the Fed's looking at. That's what they're concerned about. So definitely we'll be watching that, and also watching how implied Fed funds futures are responding to that.
Yep. All right. And thank you for listening, and we'll see you again next week.